Hello and welcome to this video. In this video, we are going to do a AS level question from paper 2, variant 22, May-June 2019, question 1. The question states that Lee, a sole trader, provided the following information from his books of account on 30th April 2019. Bank overdraft $11,240, capital $50,000, carriage inwards $670, drawings $24,060, inventory at 1st May 2018 $12,500, 3% loan $20,000, loan interest $50, motor vehicle at cost $32,000, provision for depreciation $8,000, office equipment at cost $4,600, provision for depreciation $2,400, other operating costs $61,990, provision for doubtful debts at 1st May 2018 $2,850, purchases $97,370, revenue $165,000, trade receivable $47,890, trade payable $21,640. The following information is also available. An invoice from a supplier dated 28 April 2019 for goods costing $940 had not been recorded in the books of account. These goods were unsold at the year end. Second, inventory was counted at 30th April 2019 and was valued at cost of $21,340. Revenue included goods sold in April 2019 to a credit customer for $3,200 on a sales or return basis. These goods were invoiced with a markup of 60% and were returned by the customer on 5th May 2019. Fourth, during the year, Lee took goods with a cost of $250 for his own use. Third, 3% loan was taken out on 1st August 2018 and is repayable in 5 annual installments starting on 1st August 2019. Sixth, a debt of $690 was considered to be irrecoverable and was to be written off. Seventh, the provision for doubtful debts was to be maintained at 5% of trade receivables. 8. A computer for office use was bought on credit on 1st July 2018 costing $1,200 have been debited to the purchase account. 9. Depreciation is to be provided as follows. Motor vehicle 25% per annum using the reducing balance method. Office equipment 10% per annum using straight line method. A full year's depreciation is charged in the year of purchase. In the A bit of the question, we are asked to prepare Lee's income statement for the year ended 30th April 2019. So we will further analyze the information given in our working notes, then we will proceed and make the income statement. We have the information which was given as an invoice from a supplier dated 28 April 2019 for goods costing $940 had not been recorded in the books of account. These goods were unsold at the end of the year. So this is the error of omission where we have not added this to the suppliers, that is we have not increased our trade payables, as well as this will be a part of purchases which has not been recorded. So as we have completely omitted this invoice, we are going to rectify this. So for this what we are going to do is we are going to take the trade payables and we are going to add this $940. Trade payable value was given as $21,640. To this we add $940, we get the trade payable as $22,580. Furthermore, as this was not added to the purchases because it has the double entry twofold effect, one will be in the trade payable which have to be increased, other will be the purchases which have to be increased. So the purchases was given as $97,370. To this we add this $940. We get the purchases now as $98,310. Next we have revenue included goods sold in April 2019 to a credit customer for $3,200 on sales or return basis. You see, when we talk about sales or return basis, here the sale is not completed and this should not be taken as a part of our sales based on realization concept. However, this was included in the revenue, hence this have to be reduced, as well as it has been taken as credit customer, that is, it has been taken as trade receivable, which have to be reduced. So revenue which was given as 165,000, from there we subtract $3,200, it will be now $161,800, and the trade receivable which was given as $47,890, from there we subtract $3,200, we will have this trade receivable as $44,690. Furthermore, these goods were invoiced with a markup of 60% and were returned by the customer on 5th May 2019. Inventory was counted on 30th April 2019 and was valued at the cost of $21,340, as these sales were not made, and here, as we don't take it as sales based on realization concept, this should be the part of the closing inventory as well. So it has to be increased in the closing inventory. Here it has been sold at a markup of 60%, that is, if the cost was 100%, then to this we add the markup of 60%, so the selling price was 160%. So 160 was 3,200. 100% how much? When we cross multiply this, we get the cost of goods, which is 3,200 times 100 divided by 160, which will be $2,000. This $2,000 is the cost of our closing inventory, which has to be added to the existing closing inventory, which was given as 21,340 plus 2,000. We get the value as $23,340. Next, we have 3% loan was taken on 1st August 2018 and is payable in 5 annual installments starting on 1st August 2019. So, the loan which was taken was 3% loan of $20,000. This have to be divided by 5 annual installments. So, it will be 20,000 by 5, which will be $4,000. This will be the current liability of annual installment due for the given period. And then we have to calculate the interest. We have taken the loan on 1st August 2018 and we are making the income statement for 30th April 2019. So this is the duration of 9 months. So here the loan interest will be the principal amount, which is 20,000 times 3%, which is the interest rate, times 9 by 12. We get the value as $450 as the interest on loan, which will be the expense in our income statement. Furthermore, only $50 was paid. So from $450 we subtract $50, we get $400, which will be the other payables and current liability for the present period. Next, we have the provision for doubtful debts was to be maintained at 5% of trade receivable. The trade receivables which we got in our second working notes was $44,690. From here we subtract the irrecoverable debt of $690, we get the trade receivable as $44,000. And 5% of $44,000 will be $2,200. It was given the provision for doubtful debts on 1st May 2018 was $2,850. So the difference is $650, and here there is reduction in the provision for doubtful debts, hence this will be added to the gross profit in the income statement. Then we have a computer for office use bought on credit on 1st July 2018 costing $1,200 had been debited to the purchase account. This is the error of principle, where we have taken a capital expenditure and treated as revenue expenditure. That is, office equipment is a capital expenditure and this should be debited to the office equipment account. However, we have debited it to the purchase account. So for this, we have to reduce the purchases. The purchases which we got from the first working notes was $98,310. From there, we subtract $1,200. So the purchases will be $97,110. And the office equipment was given as $4,600. To this, we add $1,200. Now the cost of office equipment will be $5,800. Next, we have depreciation is to be provided as follows. Motor vehicle 25% per annum using the reducing balance method. So for reducing balance method, we find the depreciation on net book value. So how do we get this? We take the cost of motor vehicle, which was given as $32,000. From here we subtract the provision for depreciation, which was $8,000. We get the net book value as $24,000, and 25% on this will be
$6,000. This will be the depreciation for motor vehicle for the given period. Then we have office equipment 10% per annum using straight line method. In straight line method we find the depreciation on cost, and the office equipment total which we got in our fifth working note was $5,800. 10% on this will be $580. So with this we have completed all the workings.
Now let's make Lee's income statement for the year ended 30th April 2019. We'll start with the revenue, which was calculated in the second working notes as $161,800. Then we'll take the opening inventory, which was given as $12,500. To this we will add the purchases, which was calculated in the fifth working notes as $97,110. We'll get the value as $109,610. Then we will subtract the goods for own use. This is the drawings which the owner have withdrawn the goods for his own use. This is not the part of the cost of sales as this is drawings. Hence we will subtract $250. We'll get the value as $109,360. Then we will add the carriage inwards. This is the transportation cost of getting your goods to the factory. This is the transportation cost on the purchases. Hence it will be added in our cost of sales. So we will add $670. We'll get the value as $110,030. Then we will subtract the closing inventory as we have not sold this inventory, and this will be a part of your current assets. So we will subtract this from the cost. So we'll get, after subtracting $23,340, we will get $86,690 as our cost of sales. When we subtract the cost of sales from the revenue, we will get the gross profit as $75,110. Then to this we will add the decrease in the provision for doubtful debts, which was calculated in the fourth working notes as $650. We will get $75,760. Then the other expenses which was given will be subtracted, and the other expenses was $61,990. Then we will subtract the interest on loan which was calculated in the third working notes. Then we will subtract the irrecoverable debts which was given as $690. Then we will subtract the depreciation on motor vehicle which was calculated in the sixth working notes as $6,000. Then we will subtract the depreciation on office equipment which was also calculated in the sixth working notes. After doing this, we will get the profit for the year as $6,050. In the B bit of the question, we are asked to prepare the following as they would appear in Lee's statement of financial position at 30th April 2019. First bit, we have to calculate the current assets. In current assets, we'll start with the inventory which was calculated in the second working notes as $23,340. Then we have the trade receivable which was calculated in the fourth working notes as $44,000. From there, we'll subtract the 5% of provision for doubtful debts which was again calculated in the fourth working notes as $2,200. We'll get the value of trade receivable as $41,800. When we add this to the inventory of $23,340, we'll get the current assets as $65,140. Then in the second bit, we are asked to calculate the current liabilities. In current liabilities, we'll start with the trade payable which was calculated in the first working notes as $22,580. Then we have 3% loan installment which have to be paid within a year. So that will be our current liability which we have calculated in the third working notes as $4,000. Then the bank overdraft which was given as $11,240, and the other payable which was the outstanding interest which was calculated in the third working notes as $400. So when we total this up, we will get the value as $38,220 for the current liabilities. In the C bit of the question, we are asked to state two benefits and two drawbacks of operating as a sole trader. You see, sole trader is a single owner business, so naturally all the profit belongs to the owner, that is the sole owner of the business, and the decisions are quick because only one person have to take the decision. There is no need to consult someone else, so here the decisions are taken more quickly, and naturally when one owner is there, The owner will be the whole and soul of the business. The owner takes the profit, the owner makes the decision and controls all the business activities. However, there are some drawbacks, that is unlimited liability, that is whatever is his own personal property will also be tied up if there is a case of pending loan or a mortgage. There is no limit to the loan and the mortgage, because if we go for other forms of business organization like a company limited, only the share capital invested by the shareholders are entitled when the loan or liability have to be called back. Here the owner's own property apart from the business property can also be taken away for the fulfillment of a loan or a liability, and it does not have a separate legal entity, which happens when we go for the company form of organizations, where the companies are artificial persons created by law, and as they have a separate legal entity, they have perpetual existence, that is, they will not be closed when the owner dies or retires. However, in a sole trader, if the owner dies, the organization will be closed. Then, as there is only single owner, naturally when he takes the whole profit, all the losses as well as the risk belong to the single owner, and all the responsibilities belongs to the single owner, and hence even the capital is invested by the single owner. So there is a limited opportunity of growth, as well as there will be limited opportunities for new ideas, because only one person deals with everything and does not consult with the other partners or other owners as we have in partnership. Here the ideas are also limited. So these are the various drawbacks and benefits of a sole trader. Then additional information is provided which states that Lee's friend Marvin has offered to contribute $50,000 to repay Lee's business loan and to provide additional working capital. Marvin has suggested two options. First option, form a limited company. Lee would issue 125,000 shares of one each, and Marvin would subscribe for 50,000 of these shares. Lee and Marvin will become directors of the company and will be paid an annual salary. They plan to declare dividend of 6% per annum. And the second option is they form a partnership. Marvin would introduce capital of 50,000 on which he would receive an annual interest of 6%, and he would require a 30% share of the future profits for the year. In the debate of the question, we are asked to advise Lee which option he should choose, and we have to justify our answer. So we have done the calculation in the working notes, where we will start with the first option, where we have the share capital. They are 125,000 ordinary shares issued, so and each is of $1. So when we multiply 125,000 times 1, we will get $125,000, and the dividend is 6% for this. So 6% of $125,000 will be $7,500. And for the second option, we have the annual interest which have to be paid to the Marvin, and his capital is $50,000 times 6%, it will be $3,000. In the answer, I have suggested that Lee should decide on option 1, that is, he should form a limited company with Marvin, because no doubt they have to pay a potential dividend of $7,500, but this dividend is discretionary, that is, they can reduce the amount of dividend based on the situation. If the profit is not as much as they have expected, then they can reduce the dividend, or if there are losses, they don't need to pay this dividend. So this is more flexible option, and Lee will have the control of the business, because he is the major shareholder. He will have 75,000 shares, whereas Marvin will have 50,000 shares, so he will still be in control of the business, and he will also overcome the drawback of the sole trader form of business, where he was facing a drawback of unlimited liability. Now with the limited company, he can overcome this drawback and they will have limited liability. Whereas if they go for partnership, then Marvin will have to be paid a fixed interest on his capital, that is, it will be 3000 per annum, and this will not be a flexible kind of option because this have to be paid, and this will be 3000 per annum. Apart from that, Marvin is entitled to 30% of future profit, but he will not have to bear 30% of future losses. So this is also a drawback for Lee. And apart from that, Lee will not overcome the drawback which he was facing as a sole trader of unlimited liability, because partnership firms also have the same problem, that is, they will have the drawback of unlimited liability. So based on this analysis, I have suggested that Lee should form the limited company with Marvin, as it will be more beneficial for him. Thanks for watching my videos and have a great life.